You've read about diversification. You've heard about the all-weather portfolio. You think you understand Ray Dalio's legendary strategy that manages $140 billion. You're not wrong about the principles, but you're missing the shocking reality of how he's actually deploying capital right now. I've spent years tracking what the smart money actually does, and when I pulled Ray Dalio's latest portfolio data, the first thing that jumped out wasn't bonds or commodities. It was SPY, the S&P 500 ETF, sitting at 12% of his holdings, with another 7% in IVV, which is essentially the same thing. That's over 20% in broad market exposure right off the bat. Most people think all-weather means complicated alternative investments, but Dalio's putting 1/5 of his money in the most basic index funds you can buy. The second pattern in his holdings is what really blew my mind though. Look at what comes next in his portfolio: Amazon at 4%, NVDA at 3%, Google at 2%, Broadcom at 2%, Micron at 2%, Microsoft at 1%, Taiwan Semiconductor at 1%, Lam Research at 1%, and AMD at 1%. Add it up and you've got roughly 20% of his portfolio in pure technology plays. This is the guy who preaches diversification across asset classes, yet he's betting big on the sector that's been driving markets. Take NVIDIA alone, the 3% position has probably generated more returns in the past year than some entire balanced portfolios. But here's the part that changes everything about how you should think about this strategy. There's a pattern within the pattern here that most investors miss entirely. Look closer at those tech holdings: NVIDIA, Taiwan Semiconductor, Micron, Lam Research, AMD, even Broadcom. These aren't just random tech picks. They're all connected to the semiconductor supply chain that's reshaping the global economy. Dalio isn't just buying tech, he's buying the infrastructure of artificial intelligence and advanced computing. When NVIDIA reports earnings and moves 10% in a day, it's not just affecting the 3% position, it's moving the entire semiconductor ecosystem he's invested in. The really wild part is how this connects to his third major theme. Then you see GE Vernova at 1% of his portfolio, and suddenly the whole picture clicks into focus. GE Vernova is the energy infrastructure spin-off. They build the power systems and grid technology that will support the massive energy demands of AI data centers. Dalio isn't just betting on the companies building AI, he's betting on the entire ecosystem that will power it. It's like investing in both the railroads and the steel companies during the Industrial Revolution. This is systems-level thinking at its finest, and it reveals why his approach to position sizing is so different from what most people expect. Notice how even his biggest individual stock positions are relatively small. Amazon at 4% is his largest single name, and most are under 3%. This isn't because he lacks conviction, it's because he's building positions across interconnected themes rather than betting everything on single companies. When the semiconductor theme works, 5 different positions move in his favor. When energy infrastructure benefits from AI demand, multiple holdings participate. The math is beautiful. Instead of needing one 50% winner, he can get consistent 15 to 20% gains across multiple related positions. But the most important insight is in how this philosophy should change your own approach. The real all-weather strategy isn't about holding a little bit of everything randomly, it's about identifying the major economic forces reshaping the world, then building diversified exposure to those themes. Dalio's current portfolio is essentially a bet on 3 massive trends: broad market growth through index funds, the AI revolution through semiconductors and software, and the infrastructure build-out that will support it all. Each theme gets meaningful allocation, but within each theme, he spreads risk across multiple quality companies. This is how you build wealth while sleeping well at night, and I'll show you exactly how to implement this approach starting this week. Here's what you can do right now. First, audit your own portfolio for theme-based diversification. Are you spread across the major economic trends, or just randomly diversified? Second, consider building core positions in broad market ETFs like SPY or IVV as your foundation. Third, identify 2 to 3 secular themes you believe in and research quality companies within each. Fourth, keep individual positions under 5% to maintain the risk management that lets you sleep at night. The smart money isn't smarter because they have secret information, they're smarter because they think in systems and themes rather than individual stock picks. Ready to think like the institutions? Head to nexusAIcalls.com for the advanced analysis that can transform your investment approach.